Reconstitution of a partnership firm, retirement, death of a partner. 3. You have learned that retirement or death of a partner also leads to reconstitution of a partnership firm. On the retirement or death of a partner, the existing partnership deed comes to an end, and in its place, a new partnership deed needs to be framed whereby the remaining partners continue to do their business on changed terms and conditions. There is not much difference in the accounting treatment at the time of retirement or in the event of death. In both the cases, we are required to determine the sum due to the retiring partner, in case of retirement, and to the legal representatives, in case of deceased partner, after making necessary adjustments in respect of goodwill, revaluation of assets and liabilities and transfer of accumulated profits and losses. In addition, we may also have to compute the new profit sharings ratio among the remaining partners and so also their gaining ratio. This covers all these aspects in detail. Detail 3.1 Ascertaining the amount due to retiring, deceased partner. The sum due to the retiring partner, in case of retirement, and to the legal representatives, executors, in case of death, includes I. Credit balance of his capital account. E. Credit balance of his current account, if any. E. His share of goodwill. IV. His share of accumulated profits, reserves. V. His share in the gain of revaluation of assets and liabilities. Learning objectives. After studying this chapter, you will be able to calculate new profit sharing ratio and gaining ratio of the remaining partners after the retirement, death of a partner. Describe the accounting treatment of goodwill in the event of retirement, death of a partner. Make the necessary entries in respect of unrecorded assets and liabilities. Make necessary adjustment for accumulated profits or losses. Ascertain the retiring, deceased partner claim against the firm and explain the mode of its settlement. Prepare the retiring partner's loan account, if required. And prepare the deceased partner's executor's account in the case of death of a partner and the balance sheet of a reconstituted firm. Rationalized 2023 to 24,108 Accountancy, Not-for-Profit Organization and Partnership Accounts. V. His share of profits up to the date of retirement, death. V. Interest on his capital, if involved, up to the date of retirement, death. And V. Salary, commission, if any, due to him up to the date of retirement, death. The following deductions, if any, may have to be made from his share. I. Debit balance of his current account, if any. E. His share of goodwill to be written off, if necessary. E. His share of accumulated losses. IV. His share of loss on revaluation of assets and liabilities. V. His share of loss up to the date of retirement, death. V. His drawings up to the date of retirement, death. V. Interest on drawings, if involved, up to the date of retirement, death. Thus, similar to admission, the various accounting aspects involved on retirement or death of a partner are as follows. 1. Ascertainment of new profit sharing ratio and gaining ratio. 2. Treatment of goodwill. 3. Revaluation of assets and liabilities. 4. Adjustment in respect of unrecorded assets and liabilities. 5. Distribution of accumulated profits and losses. 6. Ascertainment of share of profit or loss up to the date of retirement, death. 7. Adjustment of capital, if required. 8. Settlement of the amounts due to retired, deceased partner. 3.2 New Profit Sharing Ratio. New profit sharing ratio is the ratio in which the remaining partners will share future profits after the retirement or death of any partner. The new share of each of the remaining partner will consist of his own share in the firm plus the share acquired from the retiring, deceased partner. Consider the following situations. Normally, the continuing partners acquire the share of retiring or deceased partners in the old profit-sharing ratio, and there is no need to compute the new profit-sharing ratio among them, as it will be same as the old profit-sharing ratio among them. In fact, in the absence of any information regarding profit-sharing ratio in which the remaining partners acquire the share of retiring, deceased partner, it is assumed that they will acquire it in the old profit-sharing ratio and so share the future profits in their old ratio. For example, Asha, Deepti and Nisha are partners in a firm sharing profits and losses in the ratio of 3:2:1. If Deepti retires, the new profit-sharing ratio between Asha and Nisha will be 3:1, unless they decide otherwise. B. The continuing partners may acquire the share in the profits of the retiring, deceased partner in a proportion other than their old ratio. In that case, there is need to compute the new profit-sharing ratio among them. For example, Naveen, Suresh and Tarun are partners sharing profits and losses in the ratio of 5:3:2. Suresh retires from the firm and his share was rationalized 2023-24 retirement, death of a partner 109. Required by Naveen and Tarun in the ratio 2:1. In such a case, the new share of profit will be calculated as follows: new share of continuing partner equals old share plus acquired share from the outgoing partner. Gaining ratio 2:1 share acquired by Naveen equals 2:3. Of 310 equals 232 equals 3:10:10. Share acquired by Tarun equals 1:3 of 310. 131 equals 3:10:10. Share of Naveen 527 plus equals 10:10:10. Share of Tarun 21:3 plus equals 10:10:10. Thus, the new profit-sharing ratio of Naveen and Tarun will be equals 7:3. C. The contributing partners may agree on a specified new profit-sharing ratio. In that case, the ratio so specified will be the new profit-sharing ratio. 3.3 Gaining ratio. The ratio in which the continuing partners have acquired the share from the retiring, deceased partner is called the gaining ratio. Normally, the continuing partners acquire the share of retiring, deceased partner in their old profit-sharing ratio. In that case, the gaining ratio of the remaining partners will be the same as their old profit-sharing ratio among them, and there is no need to compute the gaining ratio. Alternatively, proportion in which they acquire the share of the retiring, deceased partner may be duly specified. In that case, again, there is no need to calculate the gaining ratio, as it will be the ratio in which they have acquired the share of profit from the retiring deceased partner. The problem of calculating gaining ratio arises primarily when the new profit-sharing ratio of the continuing partners is specified. In such a situation, the gaining ratio should be calculated by deducting the old share of each continuing partners from his new share, i.e., new profit share minus old profit share, i.e., new profit share minus old profit share. For example, Amit, Dinesh and Gagan are partners sharing profits in the ratio of 5:3:2. Dinesh retires. Amit and Gagan decide to share the profits of the new firm in the ratio of 3:2. The gaining ratio will be calculated as follows. Rationalized 2023-24 110 Accountancy, Not-for-Profit Organization and Partnership Accounts. Amit's gaining share equals 3:5:6:5:1. 5:10:10:10. Gagan's gaining share equals 2:2:4:2:2. 5:10:10:10. Thus, gaining ratio of Amit and Gagan equals 1:2. This implies Amit gains 1/3 and Gagan gains 2/3 of Dinesh's share of profit. Gaining share of continuing partner equals new share, old share. Do it yourself. Distinguish between gaining ratio and sacrificing ratio in terms of 1. Meaning 2. Effect on partner's share of profit 3. Mode of calculation 4. When to calculate. Illustration 1. 3.4 Treatment of goodwill. The retiring or deceased partner is entitled to his share of goodwill at the time of retirement, death because the goodwill has been earned by the firm with the efforts of all the existing partners. Hence, at the time of retirement, death of a partner, goodwill is valued as per agreement among the partners. The retiring, deceased partner compensated for his share of goodwill by the continuing partners, who have gained due to acquisition of share of profit from the retiring, deceased partner, in their gaining ratio. The accounting treatment for goodwill in such a situation depends upon whether or not goodwill already appears in the books of the firm. 3.4.1 When goodwill does not appear in the books. When goodwill does not appear in the books of the firm, credit is given to the retiring partner for the share in goodwill by debiting the goodwill account to gaining partners' capital accounts, individually, in their gaining ratio. The journal entry is Rationalized 2023 to 24,114 Accountancy, Not-for-Profit Organization and Partnership Accounts. Gaining partners capital A, C Dr., individually, to retiring partners capital A, C, share in goodwill of retiring partner adjusted. Let us take an example to understand the treatment of goodwill. A, B and C are partners in a firm sharing profits in the ratio of 3:2. 1B retired and the value of goodwill of the firm in valued at Rs. 60,000. A and C continue the business sharing profits in the ratio of 3:1. The journal entry for adjustment of goodwill will be A's capital A, C Dr 15,000 C's capital A, C Dr 5,000 to B's capital A, C 20,000. B's share of goodwill adjusted to remaining partners' capital accounts in their gaining ratio. It may also happen that as a result of decision on the new profit sharing ratio among the remaining partners, a continuing partner may also sacrifice a part of his share in future profits. In such a situation, his capital account will also be credited along with the retiring, deceased partner's capital account in proportion to his sacrifice, and the other continuing partners' capital accounts will be debited based on their gain in the future profit ratio. Illustration 6. Keshav, Nirmal and Pankaj are partners sharing profits and losses in the ratio of 4:3:2. Nirmal retires and the goodwill is valued at Rs. 72,000. Keshav and Pankaj decided to share future profits and losses in the ratio of 5:3. Record necessary journal entries. Solution. Journal. Date particulars LF debit credit. Amount Rs. Keshav's capital A, C Dr 13,000 Pankaj's capital A, C Dr 11,000 to Nirmal's capital A, C 24,000, Nirmal's share of goodwill adjusted to Keshav and Pankaj in their gaining ratio of 13:11. Rationalized 2023-24 retirement, death of a partner 115. Working notes 1. Vimal's share of goodwill equals Rs. 72,039 equals Rs. 24,002. Calculation of gaining ratio. Gaining share equals new share, old share. Keshav's gaining share equals 5,413. 8,972. Pankaj's gaining share equals 3,211. 8,972. Hence, gaining ratio between Keshav and Pankaj is 13:11, i.e. 13:11. 24:24. Illustration 7. Jaya, Kirti, Ekta and Shevata are partners in a firm sharing profits and losses in the ratio of 2:1, 2:1. On Jaya's retirement, the goodwill of the firm is valued at Rs. 36,000. Kirti, Ekta and Shevata decided to share future profits equally. Record the necessary journal entry for the treatment of goodwill without opening goodwill account. Solution. Books of Kirti, Ekta and Shevata Journal. Date particulars LF debit credit. Amount Rs. Kirti's capital A, C Dr. 6000 Shevata's capital A, C Dr. 6000 to Jaya's capital A, C 12,000, Jaya's share of goodwill adjusted to remaining in their gaining ratio. Working notes 1. Jaya's share of goodwill equals Rs. 236,006 equals Rs. 12,002. Calculation of gaining ratio. Gaining share equals new share, old share. Kirti's gain equals 1, 1, 2, 1, 1, 3, 6, 6, 6. Ekta's gain equals 1. Hidden goodwill. If the firm has agreed to settle the retiring or deceased partner's account by paying him a lump sum amount, then the amount paid to him in excess of what is due to him, based on the balance in his capital account after making necessary adjustments in respect of accumulated profits and losses and revaluation of assets and liabilities, etc., shall be treated as his share of goodwill, known as hidden goodwill. For example, P, Q and R are partners in a firm sharing profits in the ratio of 3:2:1. R retires, and the balance in his capital account after making necessary adjustments on account of reserves, revaluation. Rationalized 2023-24 retirement, death of a partner 119. Of assets and liabilities work out to be Rs. 60,000, P and Q agreed to pay him Rs. 75,000 in full settlement of his claim. It implies that Rs. 15,000 is Rs' share of goodwill of the firm. This will be debits to the capital accounts of P and Q in their gaining ratio, 3:2 assuming no change in their own profit sharing ratio, and crediting Rs' capital account as follows. Rs. P's capital A, C Dr. 9000 Q's capital A, C Dr. 6000 to R's capital A, C 15,000, R's share of goodwill adjusted in P's and Q's capital accounts in their gaining ratio of 3:2. Test your understanding. 2. Choose the correct option in the following questions. 1. On retirement, death of a partner, the retiring, deceased partner's capital account will be credited with a, his/her share of goodwill. B. Goodwill of the firm. C. Shares of goodwill of remaining partners. D. None of these. 2. Gobind, Hari and Pratap are partners. On retirement of Gobind, the goodwill already appears in the balance sheet at Rs. 24,000. The goodwill will be written off, by debiting all partners' capital accounts in their old profit sharing ratio. B. By debiting remaining partners' capital accounts in their new profit sharing ratio. C. By debiting retiring partners' capital accounts from his share of goodwill. D. None of these. 3. Chaman, Raman and Suman are partners sharing profits in the ratio of 5:3:2. Raman retires, the new profit sharing ratio between Chaman and Suman will be 1:1. The goodwill of the firm is valued at Rs. 100,000. Raman's share of goodwill will be adjusted, by debiting Chaman's capital account and Suman's capital account with 15,000 rupees each. B. By debiting Chaman's capital account and Suman's capital account with Rs. 21,429 and 8,571 respectively. C. By debiting only Suman's capital account with Rs. 30,000. D. By debiting Raman's capital account with Rs. 30,000. 4. On retirement, death of a partner, the remaining partners who have gained due to change in profit-sharing ratio should compensate the retiring partners only. B. Remaining partners, who have sacrificed, as well as retiring partners. C. Remaining partners only, who have sacrificed. D. None of these. Rationalized 2023 to 24,120 Accountancy, Not-for-Profit Organization and Partnership Accounts. 3.5 Adjustment for revaluation of assets and liabilities. At the time of retirement or death of a partner, there may be some assets which may not have been shown at their current values. Similarly, there may be certain liabilities which have been shown at a value different from the obligation to be met by the firm. Not only that, there may be some unrecorded assets and liabilities which need to be brought into books. As learnt in case of admission of a partner, a revaluation account is prepared in order to ascertain net gain, loss, on revaluation of assets and/or liabilities, and bringing unrecorded items into firm's books, and the same is transferred to the capital account of all partners, including retiring, deceased partners, in their old profit-sharing ratio. The journal entries to be passed for this purpose are as follows. 1. For increase in the value of assets A, C's, individually, drive. To revaluation A, C, increase in the value of assets, 2. For decrease in the value of assets revaluation A, C, drive. To assets A, C's, individually, decrease in the value of assets, 3. For increase in the amount of liabilities revaluation A, C, drive. To liabilities A, C, individually, increase in the amount of liabilities, 4. For decrease in the amount of liabilities A, C's, individually, drive. To revaluation A, C, decrease in the amount of liabilities, 5. For an unrecorded assets A, C, drive. To revaluation A, C, unrecorded asset brought into book, 6. For an unrecorded liability revaluation A, C, drive. To liability A, C, unrecorded liability brought into books, 7. For distribution of profit or loss on revaluation A, C, drive. To all partners capital A, C's, individually, profit on revaluation transferred to partners capital. Rationalized 2023-24 retirement, death of a partner 121. Or all partners capital A, C's, individually, drive. To revaluation A, C, loss on revaluation transferred to partners capital accounts, illustration 10 Mithali, Indu and Geeta are partners sharing profits and losses in the ratio of 5:3, 2 respectively. On March 31, 2017, their balance sheet was as under: liabilities amount, assets amount. As capital accounts, goodwill 25,000, Mithali 150,000, buildings 100,000, Indu 125,000, patents 30,000, Geeta 75,000, 350,000, machinery 150,000, sundry creditors 55,000, stock 50,000, general reserve 30,000, debtors 40,000, cash 40,000, 435,000, 435,000. Geeta retires on the above date. It was agreed that machinery be valued at Rs. 140,000, patents at Rs. 40,000, and buildings at Rs. 125,000. Record the necessary journal entries for the above adjustments and prepare the revaluation account. Solution. Books of Mithali and Indu Journal. Date particulars: LF debit credit 2017 amount Rs. Mar. 31 revaluation A, C Dr. 10,000 to machinery A, C 10,000, decrease in the value of machinery, Patents A, C Dr. 10,000 Buildings A, C Dr. 25,000 to Revaluation A, C 35,000, Increase in the value of patents and buildings, Revaluation A, C Dr. 25,000 to Mithali's Capital A, C 12,500 to Indu's Capital A, C 7,500 to Geeta's Capital A, C 5,000, Profit on revaluation transferred to all partners' capital accounts in old profit sharing ratio. Rationalized 2023 to 24,122 accountancy, not-for-profit organization and partnership accounts. Revaluation account. Drive CR. Liabilities amount, assets amount. As. Machinery 10,000, patents 10,000, profit buildings 25,000 transferred to Mithali's Capital A, C 12,500 Indu's Capital A, C 7,500 Geeta's Capital A, C 5,000 25,000. 35,000. 3.6 Adjustment of accumulated profits and losses. Sometimes, the balance sheet of a firm may show accumulated profits in the form of general reserve and, on accumulated losses in the form of profit and loss account debit balance. The retiring, deceased partner is entitled to his/her share in the accumulated profits and is also liable to share the accumulated losses, if any. These accumulated profits or losses belong to all the partners and should be transferred to the capital accounts of all partners in their old profit sharing ratio. The following journal entries are recorded for the purpose. I. For transfer of accumulated profits, reserves A, C drive. To all partners capital A, C's, individually, reserves transferred to all partners capital accounts in old profit sharing ratio. E. For transfer of accumulated losses all partners capital A, C's, individually, drive. To profit and loss A, C, accumulated loss transferred to all partners capital accounts in their old profit sharing ratio, for example. Inder, Gajendra and Harinder are partners sharing profits in the ratio of 3:1. Inder retires and the balance sheet of the firm on that date was as follows. Books of Inder, Gajendra and Harinder balance sheet as on March 31, 2017. Liabilities amount, assets amount. As. Creditors 50,000, bank 10,000, general reserve 90,000, cash 5,000, capital accounts, stock 30,000, Inder 100,000, land and buildings 300,000, Gajendra 55,000, Harinder 50,000, 205,000. 345,000, 345,000. Rationalized 2023-24 retirement, death of a partner 123. The journal entry to record the treatment of general reserve will be as follows. Books of Gajendra and Harinder journal. Date particulars LF debit credit. Amount as. 2017 General Reserve A, C Dr. 90,000 Mar. 31 to Inder's Capital A, C 45,000 to Gajendra's Capital A, C 30,000 to Harinder's Capital A, C 15,000, General Reserves transferred to all partners' capital accounts in the old ratio on Inder's retirement. When partner retires in the middle of the year, normally retirement of a partner takes place at the end of accounting period. But there can be a case where a partner decides to retire in the middle of the year. In such a case, the claim shall include share of profit or loss, interest on capital, interest on drawings if any, from the date of last balance sheet to the date of retirement. Here, the main problem relates to the calculation of profit for the intervening period, i.e., the period from the date of last balance sheet and the date of retirement. Let us understand by way of example. Mehra, Sabnam and Vipul were partners in a firm sharing profits in the ratio of 5:4. One profits for the year ending on March 31, 2019 was Rs. 100,000. Vipul decides to retire on June 30, 2019. The new profit sharing ratio of the firms is 1:1. Vipul's share of profit for the period of from April 1 to June 30, 2019 shall be calculated as total profit for the year ending on the 31st of March 2017 equals Rs. 100,000 Vipul's share of profit, preceding year's times proportionate period times share of deceased partner. Rs. 100,000. 3, 4, 1, 2, 1, 0 equals Rs. 10,000. The journal entry will be recorded as follows: Profit and loss suspense A, C Dr. 10,000 to Vipul's capital A, C 10,000 Vipul's share of profit transferred to his capital account. Alternatively, if Vipul's share of profit was to be calculated on the basis of average profits of the last 3 years, to which were Rs. 136,000 for 2016-17, Rs. 154,000 for 2017-18 and Rs. 100,000 for 2018-19, Vipul's share of profit. Rationalized 2023 to 24,124 accountancy, not-for-profit organization and partnership accounts. For the period from April 7, 2019 to June 30, 2019 shall be calculated on the basis of average profit based on profits for the last year calculated as follows. Total profit Rs. 136,000 plus Rs. 154,000 plus Rs. 100,000 average profit equals No. Of years 3. Rs. 390,000 rupees. 130,000 3. Vipul's share of profit Rs. 390,000 rupees. 130,000 3. Rs. 13,000. The journal entry will be Profit and loss suspense A, C 13,000 to Vipul's capital A, C 13,000 in case the agreement provides that share of profit of the retiring partner will be worked out on the basis of sales, and it is specified that the sales during the year 2018-19 were Rs. 800,000 and the sales from April 1, 2017 to June 30, 2019 were Rs. 150,000. Vipul's share of profits for the period from April 1, 2019 shall be calculated as follows. If sale is Rs. 8 million, the profit equals Rs. 100,000. If sale is Rs. 1, the profit 100,000 800,000. If sale is Rs. 150,000, the profit 100,000 150,000 800,000 equals Rs. 18,750. Vipul's share of profit equals Rs. 7,500. Profit and loss suspense A, C Dr. 75,000 to Vipul's capital A, C 75,000 for being retiring partner's share of profit for the intervening period to books of account. The following journal entry is recorded. I. Profit and loss suspense A, C drive. To retiring partners capital A, C, share of profit for intervening period. Rationalized 2023-24 retirement, death of a partner 125. Later, profit and loss suspense account is closed by transferring the amount to the gaining partner's capital account in their gaining ratio. The journal entry is E. Gaining partners capital A, C Dr. in gaining ratio to profit and loss suspense A, C. Alternatively, the following journal entry can also be passed in place of I or E. Gaining partners capital A, C drive. To retiring partners capital A, C, share of profit of retiring partner credited. 3.7 Disposal of amount due to retiring partner. The outgoing partner's account is settled as per the terms of partnership deed, i.e., in lump sum immediately or in various installments with or without interest as agreed, or partly in cash immediately and partly in installment at the agreed intervals. In the absence of any agreement, Section 37 of the Indian Partnership Act, 1932 is applicable, which states that the outgoing partner has an option to receive either interest at 6% p.a. till the date of payment or such share of profits which has been earned with his/her money, i.e., based on capital ratio. Hence, the total amount due to the retiring partner which is ascertained after all adjustments have been made is to be paid immediately to the retiring partner. In case the firm is not in a position to make the payment immediately, the amount due is transferred to the retiring partner's loan account, and as and when the amount is paid it is debited to his account. The necessary journal entries recorded are as follows. 1. When retiring partner is paid cash in full. Retiring partner's capital A, C drive. To cash, bank A, C2. When retiring partner's whole amount is treated as loan. Retiring partner's capital A, C drive. To retiring partner's loan A, C3. When retiring partner is partly paid in cash and the remaining amount treated as loan. Retiring partner's capital A, C doctor, total amount due, to cash, bank A, C, amount paid, to retiring partner's loan A, C, amount of loan. Rationalized 2023 to 24,126 Accountancy, Not-for-Profit Organization and Partnership Accounts. 4. When loan account is settled by paying in installment includes principal and interest. A. For interest on loan, interest A, C drive. To retiring partner's loan A, C B. For payment of installment retiring partner's loan A, C drive. To cash, bank A, C. Note 1. The balance of the retiring partner's loan account is shown on the liabilities side of the balance sheet till the last installment is paid to him/her. 2. Entry number A and B above will be repeated till the loan is paid off. Illustration 11. Amrinder, Mahinder and Joginder are partners in a firm. Mahinder retires from the firm. On his date of retirement, Rs. 60,000 becomes due to him. Amrinder and Joginder promised to pay him in installments every year at the end of the year to which he agreed. Prepare Mahinder's loan account in the following cases. 1. When payment is made 4 yearly installments plus interest at 12% p.a. on the unpaid balance. 2. When payment is made in 3 yearly installments of Rs. 20,000 including interest at 12% p.a. on the outstanding balance during the first 3 years and the balance including interest in the 4th year. 3. When payment is made in 4 equal yearly installments including interest at 12% p.a. on the unpaid balance. Solution. A. When payment is made in 4 yearly installments plus interest. Books of Amrinder and Joginder Mahinder's loan account. Drive CR. Date particulars JF amount. Date particulars JF amount. Rs. Year I bank 22,200. Year 1 Mahinder capital 60,000, 15,000 plus 7,200, interest 7,200 balance C, D 45,000. 67,200 67,200. Rationalized 2023-24 retirement, death of a partner 127. Year 2 bank 20,400. Year 2 balance B, D 45,000, 15,000 plus 5,400, interest 5,400 balance C, D 30,000. 50,400 50,400. Year 3 bank 18,600. Year 3 balance B, D 30,000, 15,000 plus 3,600, interest 3,600 balance C, D 15,000. 33,600 33,600. Year IV Bank 16,800. Year IV balance B, D 15,000 15,000 plus 1,800, interest 1,800. 16,800 16,800. B. When payment is made in 3 yearly installments of Rs. 20,000 each including interest. Books of Amrinder, Mahinder and Joginder Mahinder's loan account. Drive CR. Date particulars JF amount. Date particulars JF amount. Rs. Year I Bank 20,000. Year I Mohan's capital 60,000 balance C, D 47,200 interest 7,200. 67,200 67,200. Year 2 Bank 20,000. Year 2 balance B, D 47,200 balance C, D 32,864 interest 5,664. 52,864 52,864. Year 3 Bank 20,000. Year 3 balance B, D 32,864 balance C, D 16,808 interest 3,944. 36,808 36,808. Year IV Bank 18,825. Year IV balance B, D 16,808. Interest 2017. 18,825 18,825. Rationalized 2023 to 24,128 accountancy, not-for-profit organization and partnership accounts. C. When payment is made in 4 equal yearly installments including interest at 12% annually. Books of Amrinder and Joginder Mahinder's loan account. Drive CR. Date particulars JF amount. Date particulars JF amount. Rs. Year I Bank 19,754. Year I Mahinder's capital 60,000 balance C, D 47,446 interest 7,200. 67,200 67,200. Year 2 Bank 19,754. Year 2 balance B, D 47,446 balance C, D 33,386 interest 5,694. 53,140 53,140. Year 3 Bank 19,754. Year 3 balance B, D 33,386 balance C, D 17,638 interest 4,006. 37,392 37,392. Year IV Bank 19,754. Year IV balance B, D 17,638. Interest 2,116. 19,754 19,754. Note: the annual installment of payment in 4 years at 12% interest works out at Rs. 19,754 annually of Rs. 0.329234 as per annually table X 60,000. It may noted that the accounting treatment for disposal of amount due to retiring partner and deceased partner is similar, with the difference that in case of death of a partner, the amount credited to him, her is transferred to his executor's account and the payment has to be made to him, her. This shall be taken up later in this chapter. Do it yourself. Vijay, Ajay and Mohan are friends. They passed B.Com. Honours from Delhi University in June 2016. They decided to start the business of computer hardware. On 1st of August 2016, they introduced the capital of Rs. 50,000, Rs. 30,000 and Rs. 20,000 respectively and started the business in partnership at Delhi. The profit sharing ratio decided between there was 4:2:1. The business was running successfully. But on 1st February 2017, due to certain unavoidable circumstances and family circumstances, Ajay decided to settle in Pune and decided to retire from the partnership on the 31st of March 2017. With the consent of partners, Ajay retires as on the 31st of March 2017. The position of assets and liabilities are as follows: Conted. Rationalized 2023-24 retirement, death of a partner 129. Balance sheet of Vijay, Ajay and Mohan as on March 31, 2017. Liabilities amount, assets amount. As. Capital accounts: goodwill 56,000, Vijay 180,000, land and buildings 120,000, Ajay 120,000, machinery 159,000, Mohan 100,000, 400,000, motor van 31,000, bills payable 12,000, stock 90,000, general reserve 42,000, debtors 66,000, creditors 90,000, cash at bank 22,000. 544,000. On the date of retirement, the following adjustments were to be made. 1. Firm's goodwill was valued at Rs. 148,000. 2. Assets and liabilities are to be valued as under stock Rs. 72,000. Land and buildings Rs. 135,600. Debtors Rs. 63,000. Machinery Rs. 150,000. Creditors Rs. 84,000. 3. Vijay to bring Rs. 120,000 and Mohan Rs. 30,000 as additional capital. 4. Ajay was to be paid Rs. 97,200 in cash and the balance of his capital account to be transferred to his loan account. Work out the amount due to Ajay and state as to how will you settle his account. Illustration 12. The balance sheet of Ashish, Suresh and Lokesh, who were sharing profits in the ratio of 5:3:2, is given below as on March 31, 2017. Balance sheet of Ashish, Suresh and Lokesh as on March 31, 2017. Liabilities amount, assets amount. As. Capitals. Land 400,000, Shyam 720,000, building 380,000, Gagan 415,000, plant and machinery 465,000, Ram 345,000, 1,480,000, furniture and fittings 77,000, reserve fund 180,000, stock 185,000, sundry creditors 124,000, sundry debtors 172,000, outstanding expresses 16,000, cash in hand 121,000. 1,800,000. 1,800,000. Suresh retires on June 30, 2017 date, and the following adjustments are agreed upon his retirement. 1. Stock was valued at Rs. 172,000. 2. Furniture and fittings were valued at Rs. 80,000. Conted. Rationalized 2023 to 24,130 accountancy, not-for-profit organization and partnership accounts. 3. Profit share of Suresh till the date of his retirement is to be calculated on the basis of firm's last year profit, which is Rs. 200,000. 4. An amount of Rs. 10,000 due from Mr. Deepak, a debtor, was doubtful and a provision for the same was required. 5. Goodwill of the firm was valued at Rs. 200,000. 6. Suresh was paid Rs. 40,000 immediately on retirement and the balance was transferred to his loan account. 7. Ashish and Lokesh were to share future profits in the ratio of 3:2. Prepare revaluation account, capital account and balance sheet of the reconstituted firm. Solution. Books of Ashish, Suresh and Lokesh revaluation account. Drive CR. Particulars amount. Hours. Stock 13,000, furniture 3,000, provision for doubtful debt 10,000, loss on revaluation. Transferred to Ashish's capital 10,000, Suresh's capital 6,000, Lokesh's capital 4,000, 20,000, 23,000, 23,000. Partners' capital accounts. Drive CR. Date particu JF Ashish Suresh Lokesh. Date particu JF Ashish Suresh Lokesh 2017 Las. Hours. 2017 Las. Hours. June 30th revaluation 10,000, 6,000, 4,000. June 30th Bal. B. D 720,000, 415,000, 345,000. Loss. Reserve fund 90,000, 54,000, 36,000. Suresh's P&L suspense A. C 15,000 capital 20,000, 40,000. Ashish's 20,000 cash capital. Suresh's 40,000. Lokesh's 40,000 loan 498,000 capital balance. C. D 780,000, 337,000. 810,000, 544,000, 381,000, 810,000, 544,000, 381,000. Rationalized 2023-24 retirement, death of a partner 131. Balance sheet of Ashish and Lokesh as on April 1, 2017. Liabilities amount, assets amount. Hours. Capitals. Land 400,000, Ashish 780,000, buildings 380,000, Lokesh 337,000, 1,117,000, plant and machinery 465,000, Suresh's loan 498,000, furniture 80,000, sundry creditors 124,000, stock 172,000, outstanding expresses 16,000, sundry debtors 172,000. Less. Provision for doubtful debts 10,000, 162,000 cash. Hours. 121,000 hours. 40,000, 81,000 P&L suspense A. C 15,000, 1,755,000, 1,755,000. Working notes 1. Gaining share equals new share, old share. Ashish's gain. 3, 5, 6, 5, 1, 5, 1, 0, 1, 0, 1, 0. Dash. Lokesh's gain. 2, 2, 4, 2, 2, 5, 1, 0, 1, 0, 1, 0. Dash. Gaining ratio between Ashish and Lokesh equals 1:2. 2. Suresh's share of goodwill. 310 hours. 200,000 equals hours. 60,000. 3. Suresh's share of profit equals 200,000 times 3, 3, 1, 3, 1, 0 equals hours. 15,000. Illustration 13. Shyam, Gagan and Ram are partners sharing profit in the ratio of 2:1. Their balance sheet as on March 31, 2017 are as under. Liabilities amount, assets amount. Hours. Sundry creditors 49,000, cash 8,000, employees provident fund 4,000, debtors 19,000, general reserve 14,500, stock 42,000, capital machinery 85,000, Shyam 80,000, building 122,000, Gagan 62,500, patents 9,000, Ram 75,000, 217,500. 285,000. Rationalized 2023 to 24,132 accountancy, not-for-profit organization and partnership accounts. As Gagan got a very good break at an MNC, so he decided to retire on that date, and it was decided that Shyam and Ram would share the future profits in the ratio of 5:3. Goodwill was valued at Rs. 70,000. Machinery at Rs. 78,000. Buildings at Rs. 152,000. Stock at Rs. 30,000. And bad debts amounting to Rs. 1,550 were to be written off. Record journal entries in the books of the firm and prepare the balance sheet of the new firm. Solution. Books of Shyam, Ram and Gagan Journal. Date particulars LF debit credit. Amount Rs. 2017 revaluation A, C Dr. 20,550 Mar. 31 to machinery A, C 7,000 to stock A, C 12,000 to debtors A, C 1,550, loss on revaluation of assets recorded on Gagan's retirement, building A, C drive 30,000 to revaluation A, C 30,000, appreciation in the value of building on Gagan's retirement, revaluation A, C drive 9,450 to Shyam's capital A, C 3,780 to Gagan's capital A, C 3,780 to Ram's capital A, C 1,890, profit on revaluation transferred to partners' capital accounts in the ratio of 2:1, reserve A, C drive 14,500 to Shyam's capital A, C 5,800 to Gagan's capital A, C 5,800 to Ram's capital A, C 2,900, reserve transferred to partners' capital accounts. Shyam's capital A, C drive 15,750 Ram's capital A, C drive 12,250 to Gagan's capital A, C 28,000, Gagan's share of goodwill adjusted to Shyam and Ram in their gaining ratio of 9:7, Gagan's capital A, C drive 100,080 to Gagan's loan A, C 100,080, amount payable to retiring partner transferred to his loan account. Rationalized 2023-24 retirement, death of a partner 133. Balance sheet of Shyam and Ram as on March 31, 2017. Liabilities amount, assets amount. Rs. Sundry creditors 49,000, cash 8,000, employees provident fund 4,000, debtors 17,450, capitals. Stock 30,000, Shyam 73,830, machinery 78,000, Ram 67,540, 141,370, building 152,000, Gagan's loan 100,080, patents 9,000. 294,450, 294,450. Working notes, share gained equals new share, old share. Shyam's gain. Ram's gain equals, therefore, gaining ratio of Shyam and Ram equals 9:7. Revaluation account. Drive CR. Liabilities amount, assets amount. Rs. Machinery 7,000, building 30,000, stock 12,000, debtors 1,550, profit on revaluation. Transfer to capital Shyam 3,780, Gagan 3,789,450, Ram 1,890, 30,000. Partners' capital accounts. Date particulars JF Shyam Gagan Ram. Date particulars JF Shyam Gagan Ram 2017, Rs. 2017, Rs. Mar. 31 Gagan's capital 15,750, 12,250 Mar. 31 Bal. B. D 80,000, 62,500, 75,000, Gagan's loan 100,080, revaluation 3,780, 3,780, 1,890 Bal. C. D 73,830, 67,540, profit 5,800, 5,800, 2,900. Reserve Shyam's capital 15,750, Ram's capital 12,250. 89,580 100,000 and 80 79,790 89,580 100,000 and 80 79,790. Note: as sufficient balance is not available to pay the due amount to Gagan, the balance in his capital account is transferred to his loan account. 5225169854040 dash dash 311587854040 dash dash. Rationalized 2023 to 24,134 accountancy, not-for-profit organization and partnership accounts. 3.8 Adjustment of partners' capitals at the time of retirement or death of a partner. The remaining partners may decide to adjust their capital contributions in their profit-sharing ratio. In such a situation, the sum of balances in the capitals of continuing partners may be treated as the total capital of the new firm, unless specified otherwise. Then, to ascertain the new capital of the continuing partners, the total capital of the firm is divided amongst the remaining partners as per the new profit-sharing ratio, and the excess or deficiency of capital in the individual capital accounts may be worked out. Such excess or shortage shall be adjusted by withdrawal of contribution in cash, as the case may be, for which the following journal entries will be recorded. I. For excess capital withdrawn by the partner, partners capital A, C drive. To cash, bank A, C, E, for amount of capital to be brought in by the partner, cash, bank A, C drive. To partners capital A, C, consider the following situations. The adjustment of the continuing partners' capitals may involve any one of the three ways as illustrated as follows. 1. When the capital of the new firm as decided by the partners is specified. Illustration 14. Mohit, Neeraj and Sohan are partners in a firm sharing profits in the ratio of 2:1:1. Neeraj retires and Mohit and Sohan decided that the capital of the new firm will be fixed at Rs. 120,000. The capital accounts of Mohit and Sohan show a credit balance of Rs. 82,000 and Rs. 41,000 respectively after making all the adjustments. Calculate the actual cash to be paid off or to be brought in by the continuing partners and pass the necessary journal entries. Solution. The new profit-sharing ratio between Mohit and Sohan equals 2:1. Mohit Sohan. New capital-based new ratio is 80,000 40,000 existing capital, after adjustments, is 82,000 41,000 cash to be brought in on, paid off, 2,000 1,000. Rationalized 2023-24 retirement, death of a partner 135. Books of Mohit and Sohan Journal. Date particulars LF debit credit. Amount Rs. Mohit's capital A, C Dr. 2000 Sohan's capital A, C Dr. 1000 to cash A, C 3000, excess capital withdrawn by Sohan. 2. When the total capital of new firm is not specified. Illustration 15. Asha, Deeper and Lata are partners in a firm sharing profits in the ratio of 3:2:1. Deeper retires. After making all adjustments relating to revaluation, goodwill and accumulated profit etc. The capital accounts of Asha and Lata showed a credit balance of Rs. 160,000 and Rs. 80,000 respectively. It was decided to adjust the capitals of Asha and Lata in their new profit-sharing ratio. You are required to calculate the new capitals of the partners and record necessary journal entries for bringing in or withdrawal of the necessary amounts involved. Solution. A. Calculation of new capitals of the existing partners balance in Asha's capital, after all adjustments, equals 160,000 balance in Lata's capital equals 80,000 total capital of the new firm equals 240,000 based on the new profit sharing ratio of 3:1 Asha's new capital equals As 240,000 34 equals 180,000 Lata's new capital equals As 240,000 14 equals 60,000 Note: the total capital of the new firm is based on the sum of the balance in the capital accounts of the continuing partners. B. Calculation of cash to be brought in or withdrawn by the continuing partners. Asha Lata, As. New capitals 180,000 60,000 existing capitals 160,000 80,000 C. Cash to be brought in on, paid off, 20,000 20,000. Rationalized 2023 to 24,136 accountancy, not-for-profit organization and partnership accounts. Books of Asha and Lata Journal. Date particulars LF debit credit. Amount As. Bank A, C Dr. 20,000 to Asha Capital A, C 20,000, cash brought by Asha, Lata's Capital A, C Dr. 20,000 to Bank A, C 20,000, surplus capital withdrawn by Lata. 3. When the amount payable to retiring partner will be contributed by continuing partners in such a way that their capitals are adjusted proportionate to their new profit sharing ratio. Illustration 16. Lalit, Pankaj and Rahul are partners sharing profits in the ratio of 4:3:3. After all adjustments, on Lalit's retirement with respect to general reserve, goodwill and revaluation etc. The balances in their capital accounts stood at As 70,000, As 60,000 and As 50,000 respectively. It was decided that the amount payable to Lalit will be brought by Pankaj and Rahul in such a way as to make their capitals proportionate to their profit sharing ratio. Calculate the amount to be brought by Pankaj and Rahul and record necessary journal entries for the same. Also record necessary entry for payment to Lalit. After Lalit's retirement, the new profit sharing ratio between Pankaj and Rahul is 3:3, i.e. 1:1. Solution. A. Calculation of total capital of the new firm balance in Pankaj's capital account, after adjustment, equals 60,000 balance in Rahul's capital account, after adjustment, equals 50,000 amount payable to Lalit, retiring partner, equals 70,000 total capital of new firm, I, plus E, equals 180,000. B. Calculation of new capitals of the continuing partners Pankaj's new capital equals As 180,000 12 equals As 90,000 Rahul's new capital equals As 180,000 12 equals As 90,000. Rationalized 2023-24 retirement, death of a partner 137. C. Calculation of the amounts to be brought in or withdrawn by the continuing partners. Pankaj Rahul, As. New capital, As 180,000 in the ratio of 1:1, 90,000 existing capital, after adjustment, 60,000 50,000 cash to be brought in 30,000 40,000. Books of Pankaj and Rahul Journal. Date particulars LF debit credit. Amount As. Bank A, C Dr. 70,000 to Pankaj's capital A, C 30,000 to Rahul's capital A, C 40,000, amounts brought by Pankaj and Rahul. Lalit's capital A, C Dr. 70,000 to Bank A, C 70,000, amount paid to Lalit on retirement. Illustration 17. The balance sheet of Mohit, Neeraj and Sohan, who are partners in a firm sharing profits according to their capitals as on March 31, 2017, was as under. Liabilities amount, assets amount. As. Creditors 21,000, buildings 100,000, Mohit's capital 80,000, machinery 50,000, Neeraj's capital 40,000, stock 18,000, Sohan's capital 40,000, debtors 20,000, general reserve 20,000 less, provision 1,000, 19,000. For bad debt, cash at bank 14,000. 200 and 1,000, 200 and 1,000. On that death of a partner. As stated earlier, the accounting treatment in the event of death of a partner is similar to that in case of retirement of a partner, and that in case of death of a partner his claim is transferred to his executors and settled in the same manner as that of the retired partner. However, there is one major difference that, while the retirement normally takes place at the end of an accounting period, the death of a partner may occur any time. Hence, in case of a partner, his claim shall also include his share of profit or loss, interest on capital, interest on drawings, if any, from the date of the last balance sheet to the date of his death. Of these, the main problem relates to the calculation of profit for the intervening period, i.e., the period from date of the last balance sheet and the date of the partner's death. Since it is rationalized 2023-24 retirement, death of a partner 141. Considered cumbersome to close the books and prepare final account, for the period, the deceased partner's share of profit may be calculated on the basis of last year's profit, or average of past few years, or on the basis of sales. For example, Bakul, Champak and Darshan were partners in a firm sharing profits in the ratio of 5:4:1. The profit of the firm for the year ending on March 31, 2017 was Rs. 100,000. Champak died on June 30, 2017. Bakul and Darshan decided to share profits equally. Champak's share of profit for the period from April 1 to June 30, 2017, shall be calculated as follows. Total profit for the year ending on the 31st of March 2017 equals Rs. 100,000. Champak's share of profit, preceding year's profit, proportionate period, share of deceased partner equals Rs. 1,000,000,3,4,12,10 equals Rs. 10,000. The journal entry will be recorded as follows: Profit and loss suspense A, C Dr. 10,000 to Champak's capital A, C 10,000, Champak's share of profit transferred to his capital account. Alternatively, if Champak's share of profit was to be calculated on the basis of average profits of the last 3 years, which were Rs. 136,000 for 2014-15, Rs. 154,000 for 2015-16 and Rs. 100,000 for 2016-17. Champak's share of profit for the period from April 7, 2017 to June 30, 2017 shall be calculated on the basis of average profit based on profits for the last year calculation as follows. Total profit, average profit equals No. of years equals Rs. 136,000 plus Rs. 154,000 plus Rs. 100,000. 3 rupees. 390,000 equals Rs. 130,000. Champak's share of profit equals 12 3 months 4 Rs. 130,000 months 10 Rs. 13,000. The journal entry will be, Profit and loss suspense A, C Dr. 13,000 to Champak's capital A, C 13,000 in case, the agreement provides, that share of profit of the deceased partner will be worked out on the basis of sales, and it is specified that the sales during the year 2015-16 were Rs. 800,000 and the sales from April 1, 2017 to June 30, 2017 were Rs. 150,000. Champak's share of profits for the period from April 1, 2017 to June 30, 2017 shall be calculated as follows. Rationalized 2023 to 24,142 accountancy, not-for-profit organization and partnership accounts. If sale is Rs. 800,000, the profit equals Rs. 100,000. If sale is Rs. 1, the profit equals 100,000. 800,000. If sale is Rs. 150,000, the profit equals 100,000. 150,000. 800,000 equals Rs. 18,750. Champak's share of profit equals Rs. 7,500. The journal entry will be Profit and Loss Suspense A, C Dr. 2,500 to Champak's capital A, C 7,500 for being deceased partner's share of profits for the intervening period to books of account. The following journal entry is recorded. I. Profit and Loss, Suspense, A, C Drive. To deceased partners capital A, C, share of profit for the intervening period. Later profit and loss suspense account is closed by transferring the account to gaining partners capital account in their gaining ratio. The journal entry is E, gaining partners capital A, C, in gaining ratio, to profit and loss suspense A, C, P and L suspense account transferred. Alternatively, the following journal entry can also be passed in place of I and E, gaining partners capital A, C Drive. To deceased partner capital A, C, share of profit of deceased partner credited. Illustration 18. Anil, Bhanu and Chandu were partners in a firm sharing profits in the ratio of 5:3:2. On March 31, 2017, their balance sheet was as under. Books of Anil, Bhanu and Chandu balance sheet as on March 31, 2017. Liabilities amount, assets amount. Rs. Creditors 11,000, buildings 20,000, reserve fund 6,000, machinery 30,000, Anil's capital 30,000, stock 10,000, Bhanu's capital 25,000, patents 11,000, Chandu's capital 15,000, 70,000, debtors 8,000. Cash 8,000. 87,000, 87,000. Anil died on October 1, 2017. It was agreed between his executors and the remaining partners that rationalized 2023-24 retirement, death of a partner 143. A. Goodwill to be valued at 21 2 years purchase of the average profits of the previous 4 years which were, year 2013-14 Rs. 13,000, year 2014-15 Rs. 12,000, year 2015-16 Rs. 20,000, year 2016-17 Rs. 15,000, B. Patents be valued at Rs. 8,000. Machinery at Rs. 28,000. And building at Rs. 25,000. C. Profit for the year 2017-18 be taken as having accrued at the same rate as that of the previous year. D. Interest on capital be provided at 10% P. A. Half of the amount due to Anil be paid immediately. Prepare Anil's capital account and Anil's executors account as on October 1, 2017. Solution. Books of Anil, Bhanu and Chandar, Anil's capital account. Drive CR. Date particulars JF. Amount date particulars JF. Amount 2017 Rs. 2017 Rs. OCT. 1 Anil's executors 57,000 April, 1 balance B, D 30,000. OCT. 1 reserve fund 3,000 Bhanu's capital 11,250 Chandu's capital 7,500 profit and loss 3,750 suspense interest on capital 1,500 57,000 Anil's executors account. Drive CR. Date particulars JF. Amount date particulars JF. Amount 2017 Rs. 2017, Rs. OCT. 1 Bank 28,500 OCT. 1 Anil's Capital 57,000 Balance C, D 28,500. 57,000 57,000. Working Notes 1. Revaluation Account Drive CR. Date Particulars JF Amount Date Particulars JF Amount. Rs. Patents 3,000 Building 5,000 Machinery 2,000. 5,000 5,000. Rationalized 2023 to 24,144 Accountancy, Not-for-Profit Organization and Partnership Accounts. 2. Goodwill equals 2.5 years purchase times average profit equals Rs. 13,000 plus Rs. 12,000 plus Rs. 20,000 plus Rs. 15,000. 4. Rs. 60,000 4 equals Rs. 15,000. Goodwill. 5 2 feet Rs. 15,000 equals Rs. 37,500. Anil's share of goodwill. 5 10 Rs. 37,500 equals Rs. 18,750. 3. Profit from the date of last balance sheet to date of death, April 1, 2017 to October 1, 2017, equals 6 months profit for 6 months equals Rs. 15,612, equals Rs. 7,500 Anil's share of profit equals Rs. 7,500 510, equals Rs. 3,750. 4. Interest on capital, April 1, 2017 to October 1, 2017, equals Rs. 30,000,10,6, 100, 12. Rs. 1,500. Illustration 19. You are given the balance sheet of Mohit, Sohan and Rahul, who are partners sharing profits in the ratio of 2:1, as on March 31, 2017. Books of Mohit, Sohan and Rahul balance sheet as on March 31, 2017. Liabilities amount, assets amount. Rs. General reserve 25,000, goodwill 30,000, capitals, fixed assets 60,000, Mohit 30,000, stock 10,000, Sohan 25,000, sundry debtors 20,000, Rahul 15,000, 70,000, cash at bank 15,000, creditors 40,000. 135,000, 135,000. Rationalized 2023-24 retirement, death of a partner 145. Sohan died on June 15, 2017. According to the deed, his legal representatives are entitled to a balance in capital account. B. Share of goodwill valued on the basis of thrice the average of the past 4 years' profits. C. Share in profits up to the date of death on the basis of average profits for the past 4 years. D. Interest on capital account at 12% p. A. New profit sharing ratio of the firm will be 3:2 among Mohit and Rahul respectively. Profits for the years ending on March 31 of 2014, 2015, 2016, 2017 respectively were Rs. 15,000, Rs. 17,000, Rs. 19,000 and Rs. 13,000. Sohan's legal representatives were to be paid the amount due. Mohit and Rahul continued as partner by taking over Sohan's share equally. Work out the amount payable to Sohan's legal representatives. Solution. Books of Mohit, Sohan and Rahul, Sohan's capital account. Drive CR. Date particulars JF amount, date particulars JF amount. Rs. Goodwill 12,000 April. 1 balance B, D 25,000 Sohan's executor 44,158 June. 15 reserve fund 10,000. Mohit's capital 9,600, Rahul's capital 9,600, profit and loss suspense 1,333, interest on capital 625. 56,158, 56,158. Working notes 1. Sohan's share of goodwill. Goodwill of the firm. 25 equals Rs. 48,025 equals Rs. 19,200 goodwill of the firm equals 3 feet average profit. Rs. 64,034 equals Rs. 48,000. Rationalized 2023 to 24,146 accountancy, not-for-profit organization and partnership accounts. 2. Profit and loss, share of profit from the date of last balance sheet to the date of death, 2 months. 2. Rs. 64,000,225,4,512. Rs. 1,333.3. Interest on capital equals Rs. 25,000,122.5. 112. Rs. 625. Do it yourself. On December 31, 2015, the balance sheet of Pinky, Qureshi and Rakesh showed as under. Balance sheet as on December 2015. Liabilities amount, assets amount. Rs. General reserve 20,000, buildings 26,000, capitals, investments 15,000, Pinky 15,000, debtors 15,000, Qureshi 10,000, bills receivables 6,000, Rakesh 10,000, 35,000, stock 12,000, sundry creditors 25,000, cash 6,000. 80,000. The partnership deed provides that the profit be shared in the ratio of 2:1, and that in the event of death of a partner, his executors be entitled to be paid out the capital of his credit at the date of last balance sheet. B. His proportion. Terms introduced in the chapter. Retirement of a partner. Executors of deceased partner. Death of a partner. Executors account. Gaining ratio. Summary. 1. New profit sharing ratio. New profit sharing ratio is the ratio in which the remaining partner will share future profits after the retirement or death of any partner. New share equals old share plus acquired share from the outgoing partner. 2. Gaining ratio. Gaining ratio is the ratio in which the continuing partners have acquired the share from the retiring deceased partner. 3. Treatment of goodwill. The basic rule is that gaining part If goodwill already appears in the books, it will be written off by debiting all partners' capital account in their old profit sharing ratio. 4. Revaluation of assets and liabilities. At the time of retirement, death of a partner, there may be some assets which may not have been shown at their current values. Similarly, there may be certain liabilities which have been shown at a value different from the obligation to be met by the firm. Besides this, there may be unrecorded assets and liabilities which have to be recorded. 5. Accumulated profits or losses. The reserves, accumulated profits, or losses belong to all the partners and should be transferred to capital account of all partners. 6. Retiring partner, deceased partner may be paid in one lump sum or installments with interest. 7. At the time of retirement, death of a partner, the remaining partner may decide to keep their capital contributions in their profit sharing ratio. Questions for practice. Short answer questions 1. What are the different ways in which a partner can retire from the firm? 2. Write the various matters that need adjustments at the time of retirement of a partners. 3. Distinguish between sacrificing ratio and gaining tab. Rationalized 2023 to 24,148 Accountancy, not-for-profit organization and partnership accounts. 4. Why do firms reevaluate assets and reassess their liabilities on retirement or on the event of death of a partner? 5. Why a retiring, deceased partner is entitled to a share of goodwill of the firm? Long answer questions 1. Explain the modes of payment to a retiring partner. 2. How will you compute the amount payable to a deceased partner? 3. Explain the treatment of goodwill at the time of retirement or on the event of death of a partner. 4. Discuss the various methods of computing the share in profits in the event of death of a partner. Numerical questions. 1. Aparna, Manisha and Sonia are partners sharing profits in the ratio of 3:2:1. Manisha retires and goodwill of the firm is valued at Rs. 180,000. Aparna and Sonia decided to share future in the ratio of 3:2. Record necessary journal entries. Ans. Dr. Aparna's capital A, C by Rs. 18,000, Dr. Sonia's capital A, C by Rs. 42,000, Cr. Manisha's capital A, C by Rs. 60,000. 2. Sangeeta, Saroj and Shanti are partners sharing profits in the ratio of 2:3:5. Goodwill is appearing in the books at a value of Rs. 60,000. Sangeeta retires and goodwill is valued at Rs. 90,000. Saroj and Shanti decided to share future profits equally. Record necessary journal entries. 3. Himanshu, Gagan and Naman are partners sharing profits and losses in the ratio of 3:2:1. On March 31, 2019, Naman retires. The various assets and liabilities of the firm on the date were as follows: cash Rs. 10,000, building Rs. 100,000, plant and machinery Rs. 40,000, stock Rs. 20,000, debtors Rs. 20,000 and investments Rs. 30,000. The following was agreed upon between the partners on Naman's retirement. I. Building to be appreciated by 20%. E. Plant and machinery to be depreciated by 10%. E. A provision of 5% on debtors to be created for bad and doubtful debts. IV. Stock was to be valued at Rs. 18,000 and investment at Rs. 35,000. Record the necessary journal entries to the above effect and prepare the revaluation account. 4. Naresh, Rajkumar and Bishwajit are equal partners. Rajkumar decides to retire. On the date of his retirement, the balance sheet of the firm showed the following: general reserves Rs. 36,000 and profit and loss account, Dr. Rs. 15,000. Record the necessary journal entries to the above effect. Rationalized 2023-24 retirement, death of a partner 149. 5. Digvijay, Brijesh and Parakram were partners in a firm sharing profits in the ratio of 2:1. Their balance sheet as on March 31, 2020 was as follows. Liabilities amount, assets amount. Rs. Creditors